Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. You can get a copy of my book for free at nextlevelincome.com. Just click on the book link. On today's show, we have Kevin Bupp. Kevin is a Florida-based real estate investor, top iTunes podcast host, and serial entrepreneur with over 200 million of real estate transactions under his belt. His extensive investment experience spans the gamut of multifamily, office, retail, raw land, parking lots, and his favorite and by far the most profitable, mobile home parks. You're not going to want to miss this show today, as Kevin shares how he built a $30 million empire, lost it all in the Great Recession, and then has rebuilt what he has today. He also shares what has been his really core focus that allowed him to pull through that time, and also what his inspiration was to have him start his 72-hour to Key West annual bike ride that helps feed thousands of families a year. You're not going to want to miss this episode. So after this quick message, stay tuned for my interview today with Kevin Bupp. Kevin, welcome to the show.
Chris, thanks for having me, man. Excited to be here.
Oh, likewise. Man, it seems like a whole eternity ago when we last saw each other in February before COVID hit out in Colorado, but I'm getting fired up. I'm looking at taking trips out west to do some skiing here.
Yeah, me too. I know as we were talking about, February we were out there, went skiing and after the best ever conference, and then did a trip to Park City, and literally like 2 days we got back from Park City, everything shut down, and we've been stuck ever since. But I'm looking forward to getting back out there. I literally have 3 trips planned out west or here over the next couple of months. So I'm excited to get back on the skis. Well, actually snowboard, not skis.
Excellent. Yeah, I told my boys have been skiing. I picked up skiing again with them, but I told them once they can ski the whole mountain, and I figured it'd take a few years, then we'd start snowboarding. And son of a gun, out there at Keystone, my son, he did the whole mountain with me. I was like, well, I guess that's it.
There you go. Awesome.
So Kevin, I feel like, we were talking before the show, I feel like I've known you for years because I've listened to your podcast in the past, all your work with mobile home parks. I really admire the charities that you support. And I think we share some similar passions in not only cycling, but also bourbon. So for those in the audience that don't know about your story, perhaps you could share more with us. Yeah,
sure thing. And thanks, Chris, for having me here. I'll try to keep it somewhat condensed, but, I've been investing in real estate. I'm 41 now. I've been investing in real estate since I was 20. I got introduced to real estate when I was 19, kind of studied underneath a gentleman who became my mentor. It was a very accidental situation. I guess right place, right time, right? Because at that point in my life, Chris, I was tending bar, going to school, local community college. And, I had ambition. I'd always kind of hustled at a younger age. I'd a paper route. I would go mow lawns. I'd shovel snow. When I was like 14, I learned how to install car stereos in my brother's cars and build speaker boxes, like all these things. I always like to make my own way and be able to buy my own things. But as I got a little older and graduated high school, started going to school, I knew I didn't want to, I didn't know what I wanted to do. And I knew I didn't want to go away to school and waste my parents' money. I knew that if I went away, it would have $25,000 a year. And my parents weren't rich at all. We were very middle of the road, blue collar. And so I did the responsible thing and stuck around. However, I didn't really know what my future path was going to look like. And then just kind of by accident, I started dating a girl, and this girl, her mother had recently gone through a divorce, and started dating a guy by the name of David. David, local real estate investor. And so just being over at their house, on a regular basis, became friends with David, and just got to learn more about his business, what he did. He lived a very different lifestyle than what I was used to growing up. He drove a really nice car, always dressed really nice, and it seemed to have a lot of flexibility in his day. I would come see him over at the house in like odd parts of the week, like Wednesday afternoon, like 1 p.m. when, my parents were at work, right? Like they worked at 9 to 5. And so it was really odd for me to see him around. He wasn't unemployed. He actually had money, but he got to kind of choose his days, right? And how he spent them. And so that was very intriguing to me. And long story short, Dave and I, we struck a friendship. Just, again, got to learn a little bit more about what he did. I didn't really comprehend it or understand it. I understood the basics from a high level, but didn't really know the micro level details of how he did what he did and how he accomplished all that he had. And so a few short months after our friendship, I think David, I always ask him questions. I was always interested, always just trying to like peel back layers. He obviously noticed that, and he invited me to a 3-day workshop or a boot camp down in Philadelphia. Ron LeGrand's still around today.
Oh yeah.
Ron LeGrand's still around today. But I went down to this boot camp. David invited me. He paid a couple $1,000s for it. His business partner couldn't attend, and so he invited me to go, and I had no idea what it was, what I was going to learn. But I said yes. I didn't even hesitate. I said yes, and I did with him. And what I realized during those 3 days together is that, number one, there was a lot of people there that were making, what to me was a lot of freaking money, and just a couple $100,000 a year was a lot of freaking money to me. Like, my parents both made somewhere between probably $25,000 a year. My dad, maybe $60,000 a year. So again, very blue collar of the road. Neither of them ever broke that 6-figure annual income. And so this was a whole different world to me. And what I realized, number, making a lot of money. Number two, a lot of the folks I met over those 3 days didn't seem to be all that much smarter than me. I mean, they knew a lot more about real estate because they'd been doing it, but just generally speaking, they didn't seem to possess any additional skill sets that I couldn't ultimately learn with a little bit of help from David and guidance. And so I left that 3-day boot camp, excited, overwhelmed, just seeing dollar signs, and really more so feeling like this was it. Like, this was something I could wrap my arms around. Like, nothing had excited me up to that point in my life as far as future dreams, future goals, career. Nothing else had really excited me. And I surely wasn't all that excited to go to school. It just, I've never been an overly studious person, at least back then I wasn't. Now I much more am. But it just, going to college, like, wasted time for me. And so anyway, I continued going to classes. I attended bar part-time. But what I did is I went back to David a couple weeks after we got back from this boot camp. Essentially, I knew that if I didn't have help, that I would lose this, this energetic feeling. Like, it would leave me, and then I would be back, at the beginning stages again, just, understanding this real estate thing, but not really knowing what the next steps were. And so I continued with that enthusiasm. I went to David, and David, again, he was about 25 years older than I. And I went to him with a plan of, basically, I wanted to be around him more. I wanted to be in his business during the day, but how could I help him? How could I kind of give value to him so that in turn he would teach me what he knew, and I could be around him more and get to learn his business. And again, being that he was a little older than I, he wasn't as good with technology. Like, he wasn't as good with even setting up an email or creating a PowerPoint presentation. It wasn't his thing. He was a paper guy. And so I offered to help him in his business. And I did find that void existed in the technology side. And so I basically offered to be his admin assistant, be whatever he needed from me. And so I did a little bit of everything. I mean, from, picking up signed leases or delivering leases and picking up signed leases from tenants, doing showings for him on his properties. He was kind of a one-man band. He kind of oversaw everything. I would go on meetings with him with contractors, and I was just around him as much as possible. And so about a year thereafter, I learned a ton. It was just engulfed in it on a daily basis. I learned a lot, and I felt that it was time. I had saved up bartending money, and it was time to buy my own property, kind of that leap of faith. And that was scary as hell to me because I had never bought anything more than maybe like a car or like a dirt bike or something like that in my life. Right. So I'd never spent tens of thousands of dollars on something, and I had money saved up, but it was all I had. I mean, and it took me quite some time to save it. But I bought that first single family home when I was 20 years old. It was a completely rundown mess in Harrisburg, Pennsylvania, downtown area.
PA.
Yeah, really, really rough area. Even a rough area today,
right off 83, right?
Yep, right off of 83. Yeah. Just it was a row home, your typical row home, 3-story row home, and purchased that property. Utilized a lot of David's resources to renovate it. He had a lot of those relationships. I had gotten to know them over that year of working together. It allowed me to leverage a lot of those resources that he had already created. And my intent originally was to kind of follow David's model. I didn't want to fix what wasn't broken. And David's model was a buy and hold. He was much further along in his business. I didn't understand that right away, but I was like, I'm going to be a buy and hold investor as well. I'm going to buy for cash flow, right? However, I used all my money buy that property. And so that couple $100 a month I received in cash flow once I rented it out, it was going to take me a very long time, I quickly realized, to have enough money to buy another property, right? And so I quickly changed that model to basically wholesale a couple properties, buy one, keep it, wholesale a couple properties, buy one, keep it. So that became my model until I had the ability to really focus more on long-term holds. And it took a couple years to really get there before I had the capital sources. And that's when private money came into the equation. And then we really became a buy and hold investor where we, for the most part, bought with the intent of holding and turn.
I love
it. Yeah, I can continue, but I'll let you interject here for a moment.
Yeah. Well, I think there's so much about your story that I love, Kevin. First off, both of us came from, fairly humble beginnings. I grew up just south of Baltimore, not too far from you down there. You got me beat though. I was 21 when I bought my first property, but the young investors that I mentor now, we have this conversation, they look and they're like, I'm going to build my passive income and I'm going to make $200 a month off this property. It's like, well, how many do you have to buy to get there? And shifting from that, mentality. So for those that aren't listening, wholesaling is essentially, what do you do with a wholesale versus a buy and hold?
Oh, you're asking me the question? I mean, with a wholesale.
So how's a wholesale deal different than, just going and buying a rental?
Yeah. I mean, a wholesale deal is just really tying up the paper and selling the paper, up at a below market price to where there's enough room for that next investor to come in and actually do the rehab and make a profit on it. So and that's ultimately a wholesale. And then a hold for us was we'd buy it and then we'd renovate it, get it and, move in condition. And then again, turn it into a long-term rental.
Yeah, I think that's a great strategy. So if you're listening and you're not familiar with this and you're trying to figure out how am I going to get some capital, maybe this is your side gig. That's a great way, is to go out, meet other investors that are looking for buy and holds and doing that. So all right. So you're going along, you're wholesaling deals, you're buying single family, Kevin. This is all in Pennsylvania. When did you make your move to Florida?
I moved to Florida in 2002. So I wrapped up school. I bought a number of properties up in Pennsylvania, and I just, even growing up there, I mean, Pennsylvania is a beautiful place. Don't get me wrong, but I never, ever got used to the cold, and I never got used to the gray winters, when the sun doesn't really ever come out, just kind of a gloomy day. It drove me crazy from the time I was young until I was old enough to say, I'm going to get out of here and go somewhere else where it's sunny. And so I chose to move to Florida. I did do some research. It wasn't just, hey, let's go to the sun and the fun. I did some research as to vibrant markets where, real estate was trending upwards. Harrisburg was I wouldn't call it stagnant, but not a lot of action happened there. It's a little different. It's a different place today than what it was, 20 years ago. But back then, I mean, you'd be lucky if your home appreciated 2% in any one given year. I mean, you'd be doing really well. And so it's just a very linear market. It's just kind of slow moving. And so I wanted to go somewhere where it was a little bit more progressive, where there was opportunity for me to plug in with even real estate investor groups. I mean, I had to drive to Philadelphia or Baltimore to get to the closest real estate investor meeting, which is, those that don't know, it's about 2 hours to either one of those cities from where I grew up. So, and I identified Tampa, Florida as an opportunity. I mean, Tampa was very different 20 years ago than what it is today. It had a lot of growth potential, lots of plans. They were revitalizing downtown Tampa and downtown St. Petersburg, and just there was multiple different Fortune 500 companies and 100 companies moving here and or plans to move here. And so, and it was close to the beach, right? I mean, it was close to the Gulf of Mexico and absolutely a gorgeous area. So I moved down to Tampa and immediately plugged myself in. There was literally, I think, like 4 different weekly real estate groups that I, within a 45-minute radius, I could go to multiple different groups, plug into a lot of different networks. And I came down and hit the ground running, started buying. Within a couple of months, started buying property and establishing those relationships, and it went a lot faster down here just because it was. I felt like I was the oddity in a small town Pennsylvania. Like, you kind of knew the other handful of real estate investors that that own more than maybe 3 properties. But in Tampa, it seemed like there was a lot of people that owned investment portfolios, and so finding those private money resources and private lenders seemed to happen a lot quicker for me down here. And so I just started buying. I started buying up a frenzy, and so from 2002 to about 2007. I ended up acquiring just over 120 single family homes as rentals.
120.
ones that I kept like that, literally, rental units. I had wholesaled a number along the way, but again, my focus when I got down here was really buy and hold. I wanted to stay true to that model, and I'd have to sell.
And that was over how long of a period?
Here and there. So 2002 to 2007. And then I also
5 years, you bought 120 properties,
and also had just shy of 500 apartment doors and some miscellaneous, odds and ends commercial real estate. Yeah. But mostly the model is built around the single family stuff. And then the apartments, just most of them were joint ventures or partnerships that I got involved in. But yeah, did a lot of great things in a short period of time. And then everything was going up. That's all people knew. I mean, Florida was on fire, and I was very conservative about my leverage. My average leverage across the board about 66%. So I wasn't over levered. However, Florida got into a very precarious situation leading up to the crash in 2008. There was a lot of speculative building going on. I don't know if you remember back in the day when literally a pre-construction home would get flipped 5 times before it actually was fully built. Things like that were going down here left and right.
Yeah,
and
strippers buying 2 and 3 houses.
Yeah, it was absolutely crazy. There was thousands of rooftops being built for populations that weren't even here, that weren't even necessarily coming. They never came. In fact, people left because there was no jobs here for a period of time. All the construction workers left and things like that. And so we went through a period where over a period of months we lost a great deal of occupancy. One of the big things that killed us was where a lot of these, we owned a lot of older properties, 20-year-old homes, 30-year-old homes in areas where a lot of these spec homes are being built. And a lot of these builders, to kind of cover the cost, no one knew how long this was going to go on. They started renting these brand new 322s out for not much more than what we were renting our older home. And so we had a big hit in our occupancy, and that was really like the nail in the coffin. Like, we lost a good percentage of our occupancy. We weren't renewing leases. We had to give concessions. And then it literally was just a spiral effect. I mean, I'll leave it at that. Was effect. And we got to the point to where we couldn't pay debt service. And it got, we had to make some tough decisions with our property, and it gave it back to the banks, worked with a lot of the lenders. I mean, we did as much as we could to kind of work through it, but it was ugly to say the least.
Yeah.
So I lost my portfolio within a period of a year and a half, lost, the majority of a $30 million portfolio. And, I took a couple years hiatus after that. It was damage control for a couple of years. Started a few other businesses outside of real estate just to keep a roof over my head. I mean, my personal home was in foreclosure, and just really day to day trying to mentally work through and stay tough, trying to see the light at the end of the tunnel. Which when you got a sub 500 credit score and you've got credit knocking, process servers knocking on the door all the time, became very challenging. But I really turned to my health and fitness at that point in my life. I started a few businesses that were directly in line with health and fitness. And I figured that if I could keep my mind really strong and my body really strong and put the right things in it, and I at least good physically every day when I woke up, that I'd be able to get through this a lot better than that if I, turn to the bottle and start drinking like crazy and eat crap and feeling crappy. And so that's what I did. I tried to maintain a positive focus and knew that things would ultimately turn around at some point in time. And, long story short, the fire of real estate, it never left my belly. I just wasn't in a position to really, I wish I would have been, to really get back in 2010, 2011, and really buy up a lot of the opportunities that were there. But we ultimately dove back in 2011, late 2011. And at that point, it was really, I look back at what I would have done differently, right? Given the opportunity. Yeah. And what I realized is that I worked my ass off to buy those 100+ properties, those single family homes. Like, I worked butt off. I wasn't married, didn't have kids, and I had the time to do it and had fun doing it. But I had like 500 apartment units. So I almost had 5 times the amount of apartment units, and I didn't really work hard at all to buy those, but I worked incredibly hard to buy the single family properties. And the single families are they were the ones that challenged me the most when times got really tough. And so I kind of vowed to turn to multifamily to rebuild things. And that's when I stumbled across mobile home parks. So back in 2012.
2012. Yep.
Yep. Just like everything.
So that's,
go ahead.
I love, you hit a couple points there. Again, a ton of good information there, Kevin. I think, a lot of people, whether it's your health, your family, your career, if you have something that's the cornerstone, and for me, it's always been my health. If you have something that you can constantly focus on, stay in that routine, it's amazing how that can pull you through the tough times. So, if I'm listening to you correctly, so you're looking at the single family versus the multifamily.
Mm-hmm.
Obviously, I went through the same transition. I didn't have 120 properties, single family, but I realized that cash flow property withstand these downturns a lot better, because I took a huge hit as well, 12 or so years ago. So you started in mobile home parks. That's in 2012. Where are you today with your portfolio with the mobile homes?
Yeah, so we've got communities in 11 different states. Was 13. We've sold out of a few states. We're kind of steering clear now of some of the more blue states, just with rent regulations and things like that. And so we've scaled down. We're in 11 different states. We've been teetering around like this 2,000 total lot number for like 2 years now. We buy some and then we ultimately sell some, what have you. But so we've got just right around, I think, just 2,000 lots throughout 19 communities, and just closed on another community last week. And yeah, so that's our, thank you. It was kind of interesting. We had intended to roll out another fund offering. We typically do funds. And so we intended to roll that out in March. We all know what happened in March, and we put that on delay. And so really we focused on our existing portfolio for the most part of this year, just making sure that was in good shape, that we were take it through, and that, there's so many unknowns, uncertainties, and going through this before, you can imagine, like I probably much risk averse than even, like even my business partner. He hadn't gone through a downturn. So I was like, let's just put the brakes on. It's okay. There'll always be deals to buy. Let's just put the brakes on. Let's find out how this is all going to play out. Right. It's about 3 months ago, we started getting a little bit more comfortable that, our portfolio is doing great. Still high demand for affordable housing, and inevitably we started buying again just a couple months ago.
Yeah. I think mobile home parks are a phenomenal option for affordable housing, which is really, really becoming a true issue in this country. So what criteria, Kevin? So when you're looking, for us in my book, I talk about, how we target, different MSAs, different metropolitan areas, and how we develop our criteria for multifamily. What are your criteria for buying a mobile home park? How do you figure that out?
Yeah, it's a great question. And I will say that the criteria, it's a little bit more expanded than that of a typical multifamily investor. And the reason being, there's just not the sheer number of mobile home parks like there is with multifamily. So there, so I don't know the accurate number, but this number gets tossed around about 50,000 mobile home parks in the US. Of that 50,000, there's really probably only about 25,000 that are, 50 spaces or larger. Right. And so it's a fairly small number in comparison to that of multifamily. And so we've got to be a little bit more expansive, so that's why we're in 11 states, and for us, it's not just a matter of focusing on 1 or 2 or 3 markets. We will go to where the deals are, so long as they're in the Northeast, Southeast, or the Midwest. We won't go out on the West Coast. A lot of our emphasis is on the Southeast, the Sun Belt states. I mean, that's where the migration's heading. Yep. Outside of that, our criteria has kind of evolved over the years. The smallest park that we ever bought was 34 lots. We actually still own that one today up in Atlanta. But nowadays, really, 100 spaces larger. We might consider smaller, if we own something nearby, if we can gain some scales of economy there. But really, the minimum that we're looking for is about 100 spaces, and we want to, know that there's huge demand for affordable housing, and you would think that most folks would say that there's a demand for affordable housing nationwide. There are select markets that housing's pretty affordable. I always give a hard time to Flint, Michigan, but you can go and look at the demographics from Flint, Michigan. The median home is like $28,000. It's a pretty rough market there. Unemployment rate's really high. So we want to make sure that there's a demand for affordable housing. I want to know that our park's in a really good school district. And I want to know that jobs are coming to the area that aren't leaving the area, and very basic high level criteria. Outside of that, 100,000 population, which is a fairly small MSA. Mobile home parks, we're okay with secondary, even tertiary markets. Some of our best performing communities are in tertiary markets. Again, so long as there's a demand for affordable housing and there's still a diverse employment base there, and jobs are either staying or coming, not going away.
Yeah. So what's your average rent across your portfolio? And maybe I know it's market specific, but what are you typically seeing?
Yeah. So I think I'll go from like the low end to the high end. So I think On the low end, we've got some communities in the, the Gulf Coast region up in the Panhandle and then over the Mississippi. They're in the 250 range. And then on the high end of our scale in our portfolio, we've got some parks up in New York, in New York and Maryland both, where the rents are, over $500 a month. So average some there, in like the mid to high 300 range.
Yeah, and for your typical mobile home, what are people paying for their monthly payment for something like that?
If they own the home, you mean, in total? Yeah. So again, it's obviously market specific, but I think on average, if you lump together a house payment with a lot rent, probably on like a used home, something that's maybe 15, 20 years old, somewhere between $695 to, $800 a month for a 3-bedroom, 2-bath, and a brand new home, which we do. We bring in brand new homes. Their total monthly payment between lot rent and the house payment could be somewhere in the range of, $800 to $1,000, and sometimes potentially more in some of the higher expense markets.
Yeah, so you're overlapping significantly there with some of that, C+ or C grade apartment classes that are out there and doing that. My uncle lives in Colorado, and we drive through, and I see these mobile home communities. I'm like, man, these things are fantastic. Like it's impressive how high end some of these communities have gotten now.
Yeah, no, and we've got the kind of broad spectrum. We've got some, C-class communities, just hard work and blue collar communities. And we've got some really high end where literally we've got some of the communities in New York that we have. The mobile homes sell for $120,000, $130,000. And I'm talking like used mobile homes.
That's more than the first house I bought. Wow.
Yeah, no. And actually the village, I'm speaking to one specifically, the village, this community is located in, you could actually go buy a stick-built home in this village for less than what some of these mobile homes sell for. And so it's more of a lifestyle choice and decision to live there than it is affordable housing.
Can you say where that is in New York?
Yeah, it's in the Buffalo area.
Okay, cool. Interesting. No, that's fantastic. Now, Kevin, we were talking before the show. You've recently started to look at some other areas, some other cash flow areas of real estate, namely parking lots. Tell us a little bit about this. This is an area that's fairly new to me, and I'm really curious about kind of how you decided to target that area and where you were looking for those.
Sure. So I interviewed on one of my 2 podcasts, I interviewed a gentleman about 4 years ago who, parking lot, you talk about niche. I mean, parking lot's about as niche as it gets. Interviewed a gentleman about years ago who was he was an owner, but he was mostly a large broker. I think he's the largest transactional broker in the parking lot niche. And I was just intrigued. I was intrigued by the business model. I didn't know anything about it. I didn't know what the operator structure looked like, who normally, handled, the collections, was it a third party, was it the owner of the property, what have you, how consolidated was the industry. And as we dug a little deeper, I realized that, it's a very fragmented, probably the most fragmented real estate niche that's left today. More than 70% of parking lot owners only own one lot. So there's very few large institutional operators that are in the space. Don't get me wrong, there are, but it's incredibly fragmented. In addition to that, parking lots, while there's a lot of technological advances that are happening, lots of, digital payment systems, collections, what have you, a lot of these mom and pops have been, just like in mobile home parks, they've been really slowly to adapt to changes in their industry. And so there's still a lot of parking lots out there that have been owned for, generations, 40, 50 years that are in prime downtown MSAs, or, prime tourism areas that still are utilizing old collection methods, whether it be like a lot attended or, those old metal boxes where you have to shove your dollar in.
That's what I'm thinking about, those right here in Asheville. Yeah.
It's crazy. I mean, the amount of loss that comes from those type of lots that don't have a digital payment system. I don't even carry cash with me, very rarely. And so if I can't pay with a credit card, then I'm not paying. Right. And so
I think a couple quarters in and hope they don't check while I'm there or something. It's like,
and that's what happens. A lot of don't, they just assume that no one's going to check, and they probably don't, right? They don't have good enforcement. And so there's a lot of opportunity to buy lots again that are in prime locations. I'll give you an example. We just, let me back up a little bit. The other thing that's really attractive to us about the parking lot space, and now I'm talking to surface parking lots, not necessarily parking garages, but we like both, but surface parking lots, it will never be anything of less value than what it is today as a parking lot.
Yeah.
It will never be anything of less value. And so I know that if I can make sense of it financially, economically as a parking lot today, that there's only upside in the future. And so we just bought a parking lot in downtown Wilmington, North Carolina. The owner we bought it from for over about a dozen years. He was a local doctor, owned a bunch of other real estate. He bought it from a bank that had taken it back after 2008. A developer had, and ultimately his development never came to fruition, and it went back to the bank. He bought it, and he basically had his son operate this thing. It's a hard signalized intersection right in downtown historic district. I mean, right on Restaurant Row. I mean, it's about as prime as it gets. It's 27 or 28 lots. And again, his son kind of managed it. And when we looked at the financials, he was only getting about $30,000 a year of NOI. And he was asking $695 for it, which those economics just don't work. That just doesn't make any sense. And so he had been trying to kind of not haphazardly sell it for like a year or so. He hadn't really listed it or anything, but we sent a direct mailer out to that market. He was one of the few that responded. And I called on a couple other larger operators in the area that know that market. They utilize digital collection systems. They have parking enforcement. They can very quickly analyze and know how much revenue it should produce in any one given year. And one of the operators, I think they manage about 16 other lots in that downtown area. They basically within a few short days came back with an LOI for a 5-year lease at $72,000 a year on a 5-year fixed term lease. And so you can do the quick math there. We paid $695 for it, $72,000 double net lease with a prime operator, a good credit operator in that area. And so that's the beautiful thing about this business model is most of the operators in the business aren't owners of the real estate. This is a very, even the publicly traded companies, there's some big ones out there. They don't own the real estate, or most of them do not own parking lots. They're just an operational company. And so a lot of the owners are these mom and pops, or it could be a developer, but a lot of times we're looking for the mom and pop lot that they haven't fully maximized the value. They haven't let a third-party operator come in and take over the operations, or maybe they've got an operator in place, but it's like a local mom and pop operator that also doesn't utilize technology. And so this operator that we signed a lease with, they came and they put all the digital infrastructure in place. They put the collection systems in place. They put the signage in place. They did everything. That was part of the lease agreement, and we have to do nothing at this point in time other than collect $72,000 a year after year for 5 years. So
I like it.
Obviously their economics. I don't know what that lot will produce, but I'm guessing that it probably will realistically do over 6 figures a year. I don't know what their margins are typically somewhere between 10 and 20%. And so they're comfortable with their upside potential. And this is even during a pandemic. So the crazy part about this is they just signed that lease and it's not 100% back. It's only about 60% back to what it was same time last year as far as the parking revenue. But they believe in that area enough, and they know that area enough that it will ultimately come back. And they were comfortable signing a term lease to that effect.
I love it.
So
awesome. Well, Kevin, as we get near the end of the show, I want to touch on something else that I really love about what you do, which is your philanthropic efforts. I know you had to cancel your annual bike ride this year. I'm hoping to make it down next year. But if you could share with the audience what that is, why you started it, and how they can learn more if they want to join you on your ride.
Yeah, no, absolutely. I appreciate that, Chris. And I started the bike ride back in 2010. It's called 72 Hours to Key West. And as I'd mentioned, during those kind of dark years following the crash of 2008, I really turned to health and fitness. And the things I did back in 2010, this is early 2010, I was really trying to find a big life goal, like something just out of the box for me, something that pushed my limits. Because I was yearning for something, Chris. I just didn't know what it was. And so I came up with a crazy idea. I just got married, and I came up with a crazy idea that I was going to ride my bike. And prior to that, I had been riding a bike, but maybe 30, 40 miles at a time, like not any big rides. And I came up with a crazy idea to ride my bike from here in Florida to Washington, D.C. And my wife didn't fully agree with the idea, but she also didn't say no. And ultimately I did it. I literally within like 2 months, I had never ridden a long bike ride like my life. I went by myself, packed enough wash my clothes every night, put on the same thing next day. In 11 days, I rode like 1,154 miles. It was life-changing. It was literally life-changing.
Forrest Gump.
Yeah. I love it. It was life-changing. But what I realized, it was life-changing only for me personally. And when I got done with it, I was cataloging on Facebook all the way. And
yeah,
I only did it for my own purpose so I could reflect back. And what I realized, I created this massive following of people like literally watching every day, watching her updates. And I get to the end and I was personally fulfilled, but I realized that I wish I'd have taken advantage of the audience and done it for a greater cause. And so, story short, I've been helping Rod Cleef. He's a great friend of mine. He runs the Tiny Hands Foundation out of Sarasota. I've known Rod and his family for, since I moved down to Florida. And so I've been helping him feed, families every year during the holidays. And Rod went through the same crash as I did. Rod lost basically everything, and he used to self-fund his charity. And so from feeding a couple thousand families a year to feeding literally in like 2009, 2010, literally like a couple hundred families. Like he had never taken donors. And so I put this ride together after I got back from my DC ride. I was like, I need to do something locally, and I want to do something. I don't have money yet. I'm still kind of broke myself, but I've got legs and I'm in the best shape of my life. So I should put a ride together here locally, and let's raise money for Rod's charity, the Tiny Hands Foundation. And let's help feed more families this year. So that was the catalyst of it. And we started that November in 2010. And we've done it every year, again, except for this year. We've raised, haven't kept track, but on average, we donate between like $40,000 and $60,000 a year to feed, tens of thousands of families here in the Florida area. And it's exciting. Get to meet a lot of people, do great things together, and just really make a positive impact on a lot of families.
I love it, Kevin. So we'll put this in the show notes as well. What's the best way for people to find out about your ride, about your different business endeavors, or just more about you if they want to learn more about you?
Yeah. So you just go to my website, kevinbupp.com, and it's got links to, company Sunrise Capital Investors. It's got links and information about our Key West bike ride. So you can, that's a good base area to land to learn everything about what I got going on.
Awesome. Yeah, we'll link that, kevinbupp.com with 2 P's. And Kevin, question I always ask our guests before we let you go here. If you go back to your 25-year-old self, what's one piece of advice you give yourself back then?
That's a great question. That's why I always ask that question to people, and I've never been asked that question yet myself. I think just to know that you're going to run into a lot of challenges being an entrepreneur. There's going to be some really tough times, incredibly tough decisions that you have to make. And sometimes those decisions that you make might not be the right decision. Right. And you're going to have to, face the heat from it. And just know that there's very few things in life that will literally have a long-term detrimental impact on you or your business. And so know that what seems so mountainous, like that big challenge that you're facing, it seems so mountainous, or that decision you have to make, that no matter what decision you make or what route you choose to go, if it was the wrong route, more than likely, probably a couple months thereafter, maybe in a few weeks, or at least a year thereafter, it's going to seem like just peace. It's going to be small. It was going to be nothing consequential. You're going to move on with it, and you're going to move past it. So I think just really try to understand that as bad as you think things are, it's probably really not that bad. And I went through this exercise during 2008, and I learned to, every time something would come up challenging, like a threat with a loss or what have you, and I'd go through this exercise of like, what's the worst case scenario that's going to come out of this one particular event? And whenever I came up with the answer, I'd force myself the question multiple other times until I really drilled down to what is really the worst case scenario? Am I going to lose the roof over my head? Am I sleeping underneath a bridge? Am I going to lose family members? Am I going to lose friends? I mean, the things that are the most important to me, the ones that love me and the ones that are around me, am I going to lose them? No. Then is it really all that bad? Is it really all that bad? Can we push past this? Yes, we can. So
I love it. Kevin, I love your background. I love the advice you just gave there. I appreciate everything you've shared with the audience today. And we'll make sure everybody can learn about you and your ride and your other business adventures as well. Thank you so much for being on the show today.
Chris, thanks for having me, man. It's been a lot of fun. And thank you for all that you do to help everyone.
Absolutely.